Hey guys, how's it going? Lee here. So in this episode, we're going to cover the market freakout, the sell-off that's going off like crazy. J Powell coming out with some statements that I think have been blown right out of the water, and also all the things and the stocks that I'm looking at the moment, because there are some sales and where I'm actually placing my money. Anyways, guys, let's get into it. Alright, like I mentioned before, we're going to get into the market that's gone red today. Look at the S&P 500, down a fair, it's down a little bit, but again, there's also a lot of recovery stocks within the S&P 500 that kind of balances it out. What I found interesting though, is the fact that, well, if we look here, we've actually got a lot of the tech stocks that are selling off. So growth has been on, well, a massive growth spurt at the moment, given all the money that's been pumped into tech, into Tesla in particular and all that. But now we've got a big sell-off of these shares. Now we look at Tesla. Tesla has probably had the biggest sell-off, and ARK, especially Kathy Wood over there, continues to plow money into it. So she's been putting money constantly into Tesla, which is, I guess, a really good thing to see if you've been a shareholder and you've got some solid diamond hands that are still holding on. Honestly, I would still be holding on if I actually own some Tesla shares, which I do not. And honestly, even Apple is looking very appealing at 119 when it was actually at 130 plus. Okay, we've still got the app rumors about the Apple car. We've still got the new Mac devices that are coming out with the new M1 chips. So there's a lot of vertical integration and removing, other suppliers like Intel, which I think has been a great thing for them. I've got a couple of the M1 devices around the room here. So I wouldn't be surprised if you see me buy some Apple shares, just because, well, I personally use and enjoy their products, and I'm filming this on an iMac right now. Now, one of the most disrespected stocks, in my opinion, in the FANG stocks and just in tech stocks in particular, is Facebook. You're talking about a revenue beast. Profits are through the moon, and their cash holdings is in the billions, right? Tens of billions of dollars just in cash. Now, you could criticize them and say, well, holding cash isn't a very good idea. And I imagine in the future that they're probably going to hedge that and buy some Bitcoin or some cryptocurrency, something a little bit more stable to kind of deal with that, the fact that the interest rates are currently low, which could be changing based on what J Powell has come out and said. Speaking of which, let's get right into him. So J Powell's come out with some commentary about inflation. He's still, look, like I said in the last video, as long as the money printer works, who really cares? Because things are just going to keep going. And unless the money is actually being spent in the economy, we're not really going to see inflation. Now, in this video, he talks about the only time we're probably going to see it is there's going to be like a little period where people start going out to travel, to spend a lot more money. And because there's a lot more money actually being spent in the economy, the money velocity is going to start speeding up. And that's where you're going to see inflation. But then things are going to die down again and just be pretty neutral, and things are going to go back to what they have been. And what you're going to still see, in my opinion, is asset prices continue to climb up, as that's where you're going to see a lot of this stimulus money come in and being spent back into the stock market again and again. But yes, without further ado, let's check out the video.
More recently, as you point out, we've got rising vaccination, we've got cases at lower levels, we've got strong support from fiscal and monetary policy, and while there's still risks, there's good reason to expect job creation to pick up in coming months. And we need that because we're still 10 million jobs short of where we were. 10 million fewer people are working than were working when the pandemic hit. So it's a lot of ground we have to cover. And those people are mostly in areas that are directly affected by the pandemic. That's service industries, public-facing jobs. I'll also mention inflation, since that's the other side of our mandate. We seek inflation that averages 2% over time, and we want that to happen because we want it to average 2% over time. We want inflation expectations to be anchored at 2%, and that's really the goal. So right now, inflation is running below 2%, and it's done so since the pandemic arrived. We do expect that as the economy reopens and hopefully picks up, we'll see inflation move up through base effects, which means just that the very low readings of March and April will fall out of the 12-month window, and also through a surge, if you will, in spending that may come as the economy fully reopens, and that could create some upward pressure on prices. The real question is how large those effects will be, and whether they will be sustained or more transitory. And I'll just say that for several decades, the U.S. and the world economy have been in a low inflation world, and low inflation is what people expect both here and around the world. For those expectations to change, businesses and people would need to believe that larger increases in prices would be repeated year after year, And we think it's unlikely that these deeply ingrained low inflation expectations would suddenly change. It is more likely that effects like the ones I described would be one-time effects as the one-time effects of the fiscal booth fade. We have the tools to assure that longer run inflation expectations are well anchored at 2%, not materially above or below, and we'll use those tools to achieve that end. So that's my thinking on the economy.
So yeah, those were the thoughts of J Powell. Now, for a couple of you guys who might not know the correlation between real estate and interest rates and how that could affect you or the economy as abroad, I've just got my little iPad down here. I'm kind of going to draw a demonstration, okay? So let's say we've got interest rates on one side. Oh, it's not showing up. There it is. Interest rates. And then we've got property prices. I'm just going to put PP, okay? Property prices, PP. Okay, so we've got the PP on one side, and then we've got interest rates on the other side. So generally what happens is when interest rates are at all-time highs, we have property prices at relatively low prices, okay? So they're rather low. Why is that? Because, well, when interest rates are high, serviceability goes down. And serviceability, for those of you guys who don't know, is your ability to meet the monthly, the fortnightly, or the weekly payments, whatever it is, in your own residential home and in the investment properties that you have. And obviously investment properties, the interest rates on that are a lot higher than your personal place of residency as well. So obviously a lot less people are going to be able to invest in property, so then you have less buying pressure. Less buying pressure means that there's less demand and therefore property stoops to a low. Okay, so now what happens when we have interest rates at a low? Well, property prices go up. And why is that? Well, we talked about serviceability before. Serviceability becomes a lot easier, right? You're going to have to pay a lot less money into interest. So therefore, a lot more people are going to be interested in buying those properties. And so a lot more buyers are in the market. They're looking around. And so demand goes up and then they push property prices to a high because a lot more individuals are able to buy a lot more properties than they would have had otherwise, because the bank is saying, well, you're able to service probably a couple of properties, not just the one, but now you're able to service a couple more. And so because people are able to do so, they will, okay? Everybody's in the interest of increasing their own wealth. So why would you not take advantage of that and being able to service it at such low rates of, well, in Australia at the moment, you're able to get between 2 to 3%, even within our big banks who don't really negotiate a hell of a lot at all, unfortunately. So yes, guys, that's the correlation between interest rates and real estate for those of you who don't know. An interesting fact, and something that I was thinking about also, is that when interest rates actually do go back up, despite the fact that there's going to be probably a sell-off of a few properties here and there, which is why a lot of people are freaking out because their asset prices are going to go all the way down and, the economy is just going to be bad or whatnot. I have a feeling that because interest rates go up, savings accounts, the interest rates in the savings accounts are also going to go up along with it. And so what you're actually going to have is a lot of people saving their money. So this could create a deflationary effect. I'm not too sure. But ultimately, I don't see inflation as too big of a deal because everyday goods should still be at a relatively stable price, given technology kind of eliminates a lot of the overhead that companies might have to deal with, and also processes and allows us to receive goods and services at a much faster and cheaper rate. Okay, so that's interest rates and real estate. Honestly, I'm not too concerned. As he mentioned before, it's just going to be a little blip and then we're going to go back to normal. That's in my opinion. Obviously, CNBC and all of them have blown it right out of the water. So, yeah. And I wonder if they've done that actually in response to the fact that the market's gone down. Because if the market's gone back up, I imagine the responses would have been utterly and totally different. Okay? So, what else do we have? We have opportunity cost. Whoop, let me just put the iPad away. So, we've got the iPad away there. Now, what I've seen in a lot of forums, which is quite interesting when I scroll on Reddit and other content creators' channels, is, well, we've got markets that are hitting lows, right? We've got lows relative to the past month, okay? If I drew this graph actually out to like the year mark here, we're actually just going to be up. So that's just, So we've got markets crashing at the moment. We're getting some solid discounts on a lot of the tech companies in particular that are going down like 5 to 10% or so plus. But the problem is people have been buying dips around this area here, all over the place in between, just because, like I said, people want to get in at the moment. Interest rates are still low. The money printer continues to work. So a lot of people are trying to get in at the right time. The problem with that is now a lot of these people are cash strapped. People who don't have a lot of cash. And so therefore they can't buy any further into the dip. And if you actually had leverage yourself, well, that's a bad idea. But if you'd actually gone in with a lot of your savings already, I feel very, very sorry for you, and I hope you have the most solid of diamond hands and still have a job to continue holding on, because these guys, especially if you invested into good companies, they will recover, I have no doubt. But it must be scary for a lot of people who have dumped their money into these solid bull markets or continued to buy the dip along the way. I'm hoping a lot of you guys can hold this out. I personally dollar cost average into some of those things. It's a big lesson that I've learned in the past couple of years. I've learned it especially from Jeremy in financial education. Big shout outs to him. To just, when I see a good deal, I don't put all of my money in there. I might put, the cash that I'm willing to invest, maybe a fifth of it or a quarter of it. If I'm really bullish on it, that's what I'll generally do. And if another crash comes along, then I'll continue to put another quarter or another fifth and whatnot, and just dollar cost my way into it. So yeah, just psychologically can be okay with that, as opposed to just putting one lump sum and then going, oh crap, what have I actually done? So yes, be very careful of that, guys. If you guys still have some cash laying around, just dollar cost average your way as the shares go down, okay? Now, where have I been dumping my money into? So the Australian stock market, honestly, it's taken a fall, but it hasn't taken that big of a fall. The tech stocks have been hit, in particular buy now, pay later. We've got Afterpay going down about 27% from 150 to 160 all the way down to 115. Just kind of disgusting to see. And Zip, one that I hold personally, has gone from the highs of, what was it, like $14 down to today at $9.56. And I will be honest in saying that I did dump a solid 4 figures into Zip and bought some more shares as it dipped down. I do see this going into maybe the $20 region for sure, especially with the fact that they're listing over in the US, and also Klarna just raised like $1 billion over there, and Combank actually owns them now. So the fact that they've evaluated that over in the US at that valuation, I just wonder what Zip is going to get in terms of a valuation and some cash, and what they can actually do with that money, the validation that would provide, etc., the exposure on the news. There's so much benefit in that. So I've been dollar cost averaging my way down with Zip just to add more shares to my holdings. If you've been around the channel for long enough, you know that I've bought this back when it was like $2 something. Yes, so anyways, last point, what am I looking at? I'm looking at US tech. I'm filming this on a Friday night here in Australia, so Saturday morning when the markets open in the US in the early mornings. Here in Australia, I'm sure things might change. If it continues to take a dip, then goddamn, I am kind of afraid to see what's going to happen on Friday. But that's it, guys. If you guys do want to trade in Australia, I've got a couple of links down below. If you haven't used Self Wealth, there's a referral link down below. Use that. We both get 5 free trades. That's very good. It's going to save you $9.50 per trade. It's the cheapest share-sponsored platform in Australia. Also, there's a stake. There's a couple of links down there. Give this video a thumbs up if you've made it all the way to the end. Apart from that, guys, I'll catch you guys in the next update. Cheers.